All right, let's just get right into it. Today, we are putting Kinder Morgan, ticker KMI, through the absolute ultimate valuation gauntlet. We're not just glancing at a few charts today, we're stepping directly into the shoes of expert investment analysts. Using a mountain of source data, including their latest Q1 2026 10Q filing, we're going to evaluate this energy infrastructure giant using the time-tested frameworks of some of the most legendary investors in history.
So here's the game plan for this analysis. We'll start with a quick snapshot of the company, and then run it through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, before crunching the numbers with some quantitative models to land on our final recommendation.
All right, part one. Let's get a quick snapshot of the absolute heavyweight stepping into the ring today.
If you follow energy, you know Kinder Morgan is a titan in North American infrastructure. I mean, they transport roughly 40% of all U.S. natural gas consumption. That's through about 78,000 miles of pipelines. Right now, they're trading at $32.49 a share, and they've got this massive $10 billion backlog of long-haul gas projects. And the real catalyst here? It's the surging demand from U.S. LNG exports, combined with the explosive energy needs of AI data centers that desperately need reliable baseload power. Financially, they just crushed it with a record-breaking Q1 2026, pulling in $4.8 billion in revenue and hitting $1 billion in net income.
Just to set our baseline here, pulling straight from their latest 10Q filing, we're looking at roughly 2.224 billion shares outstanding. You multiply that by our current share price, and boom, we lock in a market cap of approximately $72 billion.
Moving on to Section 2, let's see how they hold up under the Warren Buffett lens, focusing on economic moats and owner earnings.
You know, Buffett absolutely loves a wide economic moat. And honestly, moving 40% of the nation's natural gas, that is a practically insurmountable barrier to entry. Nobody is just gonna build a competing network tomorrow. They've got incredibly consistent, fee-based cash flows that just brush off commodity price swings. In Q1 alone, net income jumped $259 million year over year. If you annualize that against their equity, you get a solid return on equity of about 12.4%. Now, we do have to talk about the debt. It's high, $32 billion total. But you know, that's pretty standard for utilities and midstream companies with huge upfront capital costs. Plus, management seems totally focused, and they just successfully extended their revolving credit facility out to 2031.
But to really think like Buffett, we've got to calculate his famous owner earnings. So you take that Q1 net income of roughly $1 billion, add back the $633 million in depreciation and amortization, and then subtract the $145 million or so in sustaining capital investments. That leaves us with Q1 owner earnings of approximately $1.48 billion. I mean, they are just throwing off cash. But Buffett is strict about his margin of safety. The business quality is absolutely there for sure, but we'd probably need a bit of a price dip before the Oracle of Omaha would back up the truck.
Next up, Section 3. Let's shift gears and apply Peter Lynch's framework, categorizing the business and checking out the PEG ratio.
When you dig into the Q1 numbers, you'll see a $258 million year-over-year jump in earnings before depreciation and amortization just for their natural gas pipeline segment. That kind of steady, incremental progress proves Kinder Morgan is a classic Peter Lynch stalwart. You know, it's a massive, reliable dividend payer that still manages to eke out consistent growth. It's largely insulated from economic shocks, even if it isn't going to double in size overnight.
But here's where the math gets a little tricky. Lynch relies heavily on the PEG ratio, price to earnings divided by the growth rate. Right now, KMI is sitting on a PE of around 18.4. Now, if we assume a fairly conservative 5% earnings growth rate out to 2029 based on their backlog, that spits out a PEG ratio of 3.68. And for Lynch, well, anything over a 1.0 starts looking expensive. So 3.68, that's noticeably overvalued in his book.
So what's the verdict here? Their balance sheet is resilient, and that expected 1.194 dividend is definitely sweet if you're an income investor. High institutional ownership is standard for this sector too. But because of that elevated PEG ratio, Lynch would likely label this a solid hold at current prices. It's a fantastic company, no doubt about it, but you are absolutely paying a premium for that stability.
All right, Section 4. Let's subject this stock to the grueling Benjamin Graham defensive investor checklist.
Graham is all about asset protection and the ultimate margin of safety. Running through his checklist, they easily pass the adequate size test with that $72 billion market cap. Earning stability? Pass. Unbroken dividend record?
pass. Their price-to-book ratio of 2.3 also passes his moderate requirement. But they completely fail his strict strong financials test, all because of that $32 billion debt load. Graham absolutely hated high leverage because it introduces bankruptcy risks during downturns, which kind of destroys your margin of safety. Also, that PE of 18.4 is hovering right on the very edge of his comfort zone.
So if we crunch Graham's famous intrinsic value formula, taking the square root of 22.5, multiplying it by an annualized $1.76 earnings per share, and then multiplying that by their $14.07 book value per share, we get an intrinsic value of exactly $23.60. What does that mean for us? It means at the current price of $32.49, there is zero margin of safety for a pure Graham defensive investor.
Moving into Section 5, let's strip away the guru philosophies and just look at the raw math with our discounted cash flow and alternative models.
To build out a solid base case DCF, we have to make a few informed assumptions based on the data. We're forecasting a 5% free cash flow growth rate, largely driven by that $10 billion backlog. For the terminal value, we're using a 2% perpetual growth method just to mirror long-term inflation. And finally, since the exact number isn't explicitly in the 10Q, we're applying a standard industry average of 8% for our weighted average cost of capital to discount that future cash back to today.
Running those numbers through the model gives us a base case fair value of $35.33 per share. And honestly, this lines up perfectly with analyst narratives projecting about $20.2 billion in revenue by 2029. Even if we stress test this, say tweaking the cost of capital up to 9% or dropping terminal growth down to 1.5%, the fair value still hovers nicely in that range. So at our $35.33 base case, we're looking at roughly an 11% upside from where it's trading right now.
But hey, as analysts, we never rely on just a single model, right? If we apply a dividend discount model, assuming a 6% discount rate and 2% dividend growth based on their stated 119 target for 2026, we get a much more conservative fair value of $29.75. On the flip side, though, if you look at comparable market multiples, some of the more bullish community estimates stretch the fair value all the way up to $52.03. That is, of course, if the market decides to really slap a premium on their AI infrastructure exposure.
Finally, Section 6. It's time for the synthesis and our final recommendation.
Let's bring all these disparate threads together. When we line up all our models, the current price of $32.49 sits right smack in the middle. It's well above Graham's bargain basement target of $23.60 and slightly above the dividend discount model. But it is safely below our DCF intrinsic value of $35.33, which gives us a modest runway for capital appreciation.
Look, the strengths here are basically undeniable. Between the $10 billion backlog and this massive AI and LNG supercycle demand, their 40% stranglehold on U.S. natural gas transport is literally more valuable than ever. Add in those predictable fee-based cash flows and a growing 1.19 dividend, and you've got a massive safety net. But we can't ignore the risks. That $32 billion debt load is heavy, meaning we have to watch their 3.8x net debt to adjusted EBITDA target and interest coverage ratios like a hawk.
So after running through the minds of Buffett, Lynch, Graham, and some rigorous DCF modeling, what is the ultimate verdict? Is KMI a buy, hold, or sell at $32.49?
Blending it all together, Kinder Morgan looks like a rock-solid hold at $32.49. If you're an income investor looking for a defensive, fee-based yield, it's incredibly attractive. The price is fundamentally fair, but honestly, it just isn't a screaming bargain right now. To trigger a Buffett-style buy with a 20% margin of safety, we'd really need the price to dip down to around $28. For Graham to even glance at it, he'd demand a 33% discount to his intrinsic value, which puts his buy trigger at a pretty unlikely $15.73. And Lynch, he'd need a massive, unexpected growth surge to justify that current PEG ratio.
But I want to leave you with a thought to chew on as we wrap up this explainer. As AI data centers demand absolutely unprecedented amounts of natural gas baseload power over the next decade, are these traditional valuation models built for an older economy, fundamentally underestimating the true lifespan, growth, and intrinsic value of Kinder Morgan's irreplaceable infrastructure? Because if the answer is yes, that $35 DCF valuation might just be the floor. Something to think about.